Imagine a professional runner, once so sick they were on life support. Now imagine them just a few years later, standing on a podium finish. That is the story of the Bank of Maharashtra. Back in 2017, the bank was in serious trouble. Like many lenders at the time, they had issued massive loans to large corporate borrowers. But when those big companies stopped paying them back, the bank's financial health began to fail. In banking, a bad unpaid loan is called a non-performing affect, or an NPA. Think of an NPA as a heavy iron weight strapped to a runner's ankle. The more NPAs a bank has, the harder it is to move forward. By 2017, the bank had accumulated so many of these weights that the Reserve Bank of India stepped in. They placed the bank under a strict framework called prompt corrective action. This framework was essentially a financial intensive care unit. Regulators grounded the bank, restricting its ability to hand out new loans so it wouldn't collapse. It was a forced, grueling rehabilitation to save the institution from failing. The first step to recovery was dropping that bad weight. Management had to write off old debts and recover as much cash as possible from those borrowers who weren't paying. This chart shows the bank's net non-performing assets over time. In 2017, their bad debt sat at nearly 12%. Follow the line down to March 2026. They drove that number to just 0.13%, the lowest among peers. To stay safe, they built a massive reserve fund. Their provision coverage ratio hit 98.59%, creating a thick safety net protecting against future falls. This means that for almost every bad loan the bank has, they already have the cash set aside to cover it. Their balance sheet has transformed from being vulnerable to being stable and well protected. To safely build muscle again, the bank changed its diet. Instead of taking on massive, risky corporate loans, they pivoted to a steadier source of income. They focused on everyday retail customers and micro, small, and medium enterprises, often called MSMEs. These are the small businesses that drive the local economy. Lending to these smaller borrowers grew by over 20% every year. At the same time, the bank's internal metabolism improved. Their cost-to-income ratio dropped to 36.5%, meaning they became far more efficient at running their daily operations. This means it costs the bank far less money to generate more revenue. Every dollar the bank spends on its own operations now goes much further than it did before. Because they are operating leaner, the bank is generating more profit for every dollar of assets they own. This metric, known as return on assets, rose to 1.86%. For context, that puts them at the top of their industry for efficiency. This rigorous training led to the ultimate payoff. For fiscal year 2026, Bank of Maharashtra delivered a record-breaking net profit of 7,019 crore rupees. This wasn't a small gain. It represented a 27% jump in profitability in just 12 months. They are also keeping their internal immune system strong. Their capital adequacy ratio is 18.36%, which is the amount of extra capital they hold as a buffer. While those profits are record-breaking, this capital buffer provides the safety margin that helps protect the bank and its customers from future economic shocks. The market noticed this turnaround. Institutional investors began buying in, driving the bank's stock price to outperform the broader market averages. A healthy athlete celebrates by sharing the victory. To reward the people who invested in them, the bank announced both interim and final cash dividends. These dividends are direct rewards given to the shareholders who held on to their stock even during the bank's darkest days in the ICU. Bank of Maharashtra shows that with discipline and strong fundamentals, even a failing institution can be brought back to peak condition.